Good afternoon and welcome to this online seminar. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance. And it is a real pleasure for me to introduce and moderate today's online seminar, the first of the year, on debt sustainability assessment in normal times and in times of crisis in cooperation with CEPS. We'll wonder today whether debt sustainability assessment should or could be the cornerstone of fiscal surveillance, and we'll ask ourselves to what extent it can act as a credible early warning signal in times of crisis. These questions are to be put in a context, at least in my view, of an increased opacity of the EU's fiscal framework, which results in an ever-growing difficulty to understand where EU institutions exercise constrained discretion or outright discretion. Against this background, I'm very, very glad to be in the company of Cinzia Alcidi, who is head of the Economic Policy Unit and Senior Research Fellow at CEPS, and of Daniel Gros, who is Director at CEPS. Cinzia, Daniel, many thanks to both of you for being with us today, all the more so in a moment where you must be extremely busy organizing your fantastic IDs lab on Europe's Choice held in Brussels on 21st, 22nd February. Many thanks also to my colleague Jan, who has prepared the seminar, is managing our online platform as we speak. To save some time, I will not give further details about your professional backgrounds. Our participants can have a look at our website where your short bios are available. Okay, so before telling you more about our audience, I'd like to spend just a few minutes to inform you about our school's upcoming activities, be it for you or for your colleagues. You may know by now that the Florence School of Banking and Finance, FBF in short, is a non-national training platform which is part of the European University Institute. The European University Institute is a very distinctive place because it's a public, intergovernmental research and education institute which boasts an international community of more than 60 nationalities and offers doctoral and executive education programs in economics, law, political science, and history. A recent program of the EUY, the FBF, is a place where various generations meet to discuss and argue about cutting-edge topics of financial stability and macroprudential policies, risk management, as well as regulation, supervision, and resolution. Our school has a diversity of policy debate and training activities, meaning that the online seminars that we're having are only one of many activities that we run. For example, we released a few months ago our last ebook on institutions and the crisis, which gathers contributions from senior policymakers, private practitioners, and academics, and can be downloaded for free on our website. On the training side of things, you can see on the slide that our school has been training more than 2,000 participants coming from 68 countries and a variety of organizational backgrounds since its creation. Over the next months, we'll be hosting several residential courses, including a course on debt restructuring that should be of interest to you attending the seminar today. The course will be taught by Professor Mito Gulati from Duke University. Also, it will be taught by Lee Buchheit from Cleary Gottlieb and by Jérôme Zettelmeier from the Peterson Institute. It will be held here in Florence on 23 and 24 April. Back to our 25th April annual FBF conference, which, by the way, this year will feature a session on debt restructuring. For the rest, we have 13 courses lined up until the summer, several of which are already fully booked, so more details can be found on our website, but do not wait the last moment to register. You will see that also we'll have courses this year on anti-money laundering, on securitization, that's in February, on leverage cycles and the macroeconomy, on non-performing exposures, and later on also on stress testing, on sovereign risk, I mentioned it, on MiFID and on insurance, to mention only a few. Right, so I think it's time to thank you for your patience first and to introduce you to one another. So you don't see each other, let me do the presentations. You are around 110 participants connected today, following us from almost everywhere in Europe and from some places in the world. 44 nationalities are represented, and we're very glad, like in the past, to count on several participants, as always from the Commission, the ECB, the Single Resolution Board, as well as from the European Stability Mechanism, Banque de France, and Crédit Agricole, to just name a few. Of course, we welcome all the other participants from the organizations I didn't mention. In terms of gender balance, we have 42% of you who are women, 58% are men. You have about 9.2 years of professional experience on average. 66 of you are trained economists, that's not a big surprise. 17% of you are lawyers, 8% are trained in business. And lastly, quite in comparison to previous editions, quite a different outlook. We have 60% of you who have master's degrees and 34% who have a PhD, while 6% have a bachelor degree. Right, so time to start. How will our seminar be organized exactly? Well, it's quite simple. Cinzia and Daniel will lead us through the topic of today for about 25 minutes. Their talk, as they will show you, will be interrupted by 3 polls, which will appear on your screen and will be presented by our speakers. Following this, we'll open up, as is a tradition, the Q&A session, where you guys will step in and write your questions or comment in the chat box, and that the chat box itself will appear in due course at the bottom of your screen. So let me stop here, disappear, and leave the floor to Cinzia and Daniel, who are live from Place du Congrès in Brussels. So you're connected. We see you very well. The floor is yours.
Thank you very much, Pierre, and good afternoon to everyone from Brussels. I give you the floor to Daniel, who will run the first part of the presentation, and then take over, and then Daniel will conclude. Daniel? Okay, thanks. It's a pleasure from my part as well. And I wanted to give a few introductory remarks, which are actually not tightly linked to the motivation of the paper, because the motivation of the paper and the presentation today was a request from the European Parliament to review and compare, on the basis of the available information, the IMF, basically the European models and assumptions underlying their respective DSA, Debt Sustainability Analysis. So that was a request from the European Parliament, and basically also they wanted to know, why did these 2 institutions come to a different result regarding Greece? Let's put that as a background for a minute aside, and give me perhaps a couple of minutes just to talk about 2 things which I think are important to keep in mind as a general background. And there are 2 things to keep in mind. First of all, why should sustainability be a problem in an era in which the interest rate is smaller than the growth rate? You have perhaps all of you seen the presidential address of Blanchard to the AEA, where he talked about that as well. What's the problem? He basically says the interest rate, if it's lower than G, all you need is not to have excessive deficits, basically. And by the way, if you look at the results of Schularik on the history, you find that even over hundreds of years, the quote-unquote risk-free rate has usually been below the growth rate also, right? So in that sense, what's the problem? And let's come back to that later, because in order to create a problem, so to speak, you have to have some explosive feedback mechanism, and then the details of that mechanism matter a lot. And the second point is one which I always like to make, and which is little taken up by the official institutions, which is that there's a difference between domestic and foreign debt. And there, let me just make a few remarks about that first. These are qualitative remarks, if you can advance. So first of all, if domestic residents hold the debt of their own government, this is not a net debt at the level of society. And in particular, if the risk premium increases, then this is a transfer from one pocket to another pocket, from the bondholders to the taxpayers. Of course, the 2 might not be the same. There might be political fights between the 2, but both of them are voters. And that, of course, is very important when countries have to decide whether to default or not.
And by contrast, if you think about the case where public debt is held by foreigners, then an increase in the risk premium means a transfer abroad. So it has a different impact on the economy. Think to that in terms of Italy versus Greece, to which we come back later. Debt ratio 130% of GDP, risk premium of 2. It means the risk element is 2.6% of GDP. Whether to pay that to your own citizens or you have to pay to foreigners, it makes a difference. And that is something which that is not appreciated a lot. So as an introduction for Cinzia, let me now come back to this essential element. One thing which I forgot, which is that, and that is a very important topic in the context of QE. If the debt is held domestically, then it matters who holds it. Retail investors or leveraged financial institutions like banks. Because if it's held by banks, when you have a crisis, now either you cut deposits, and if you don't cut deposits, there's very little you can do. Because if you bankrupt your banking system, the costs are just too high. And that's why basically these domestic defaults happen very rarely. Reinhardt and Rogoff say that the ratio of foreign defaults on foreign debt versus domestic debt is roughly 7-1. I have not looked at what is the associated cost with each one. They might also be different, but that is the topic perhaps for other people to research. So it matters a lot who holds the debt. Let me just make one very small parenthesis. What happens if the national central bank of a country in the euro area, so a central bank which cannot print money, buys the debt of its own government? Principle, if there is a default, what does it imply? There are fewer there's fewer bonds outstanding in the hands of private investors. So if you want to cut the debt of the government, they have to carry a higher burden. So the loss given default should increase if the central bank holds an important proportion of debt. The probability of default might decrease, but that's something else. Okay, let me come now to the first issue which I mentioned. Why do we bother? Here I've given you just the difference between the interest rate and the growth rate over the three big areas, three big currency areas or economies in the world. And you see that beginning from the 1990s had come down, and it's now reliably negative, and most negative for the euro area. And if you look carefully, you might see that here I have already data until 2020, 2023. This is data from the IMF. So the predictions are that this will go on for quite some time. So why do we bother then? What's the problem? And the problem is that we have to have some other mechanism, a feedback mechanism from high debt levels to the interest rate. That I've put here in the title. Cinzia will come back to that. You have the total interest rate on government debt is the risk-free rate plus a risk premium. And if that risk premium depends on the level of debt to GDP ratio, then you can get easily explosive behavior. Here I've just given you some simulations which we have done, just using the parameters from the IMF. What happens if you start at a debt ratio of approximately, what is it here, 1.3, right, 130% of GDP. And even, and this is very important, even with a surplus of 3% of GDP, you can wander off to infinity and into unsustainability, although the risk-free rate is below the growth rate. So this is the importance of the risk premium and this feedback. Of course, the opposite of that is if your debt is below a threshold, then it also goes down to zero very quickly. But it's this kind of this self-reinforcing impact which I think is actually at the heart of that sustainability analysis and which makes it relevant still today in this environment of low rates and, let's say, respectable nominal growth. That is, I think, what you should keep in mind when we talk now about how to do in real life a DSA, which Cinzia will do now.
Okay. Thank you very much, Daniel, for this background. So what I will be focused on is really to explain a bit how the IMF and basically the European Commission performed that sustainability analysis. I will focus only on these two institutions because these are the only two who perform formal and official analysis. Now, the way we approach the comparison between these two analyses is basically to focus first on distinguishing different functions of DSA. And in particular, the idea it was to focus on when the analysis is done under normal times and when this is done in times of crisis. So under normal times, DSA is basically used as early warning signal of fiscal vulnerability. So it's a sort of standard and routine exercise. While in the case of crisis, DSA becomes one of the key tools for decision making about whether to provide financial assistance. And when we're talking about financial assistance in the context of the IMF and in the context of the euro area, we should keep in mind that IMF provides assistance in the case of balance of payment crisis, and in principle to any country of the world, while the European Commission provides financial assistance in case of financing problems to sovereigns of the euro area. So the potential beneficiaries of this support are actually very different in the two cases. And this actually led us to consider another element, the different institutional perspective and the different constituencies that the IMF and let's call it the European Commission have to represent, to take into consideration when taking their decisions. And then basically we compare the technical aspects of the methodology. Now, before we go into the details of the comparison, I would like to highlight that no matter who does that sustainability analysis, there are some elements which are common. And in particular, the first one is that sustainability analysis consists in basically projecting future path evolution of debt and considering the willingness and ability of governments to service this debt at any point in time. Now, one aspect here deserves observation, and we'll come back to this point later, is that in the DSA, the key reference variable, the denominator, I'd say, is the GDP. Now, it should be considered that in practice, servicing debt is done through taxation, and the ability of countries to raise taxes and collect taxes may be actually very different. So this is an aspect that is additional, and to consider what one can draw from the debt sustainability assessment, where the focus is only on GDP. The second element is, as I mentioned at the beginning, is that no matter who does the debt sustainability assessment, there are basically three variables which are key. And these to some extent are fixed, and they are GDP growth, interest rates on public debt, and fiscal balance. Now, the crucial issue in the debt sustainability assessment, and this is really the core of the problem, is that basically we need to make assumptions about the future evolution of these variables. And there is a lot of uncertainty around them. So one critical element is how to make assumptions which are actually realistic. And as I will explain in a moment, actually both the Commission and the IMF devote a lot of importance, for instance, to track records and to other elements which can help to make assumption realistic, even though, of course, its uncertainty remains quite high. Now, in this table, we have summarized basically the main, if you want, item or pillars along which the differences between the IMF approach and the Commission approach will be explained just in a moment. So this is a summary of issues which will be then addressed more in detail in the following slides. So one first difference between IMF and Commission approach is the time horizon. In the IMF, this is set and it's standard, and it's usually 5 years. In the case of the Commission, actually, in the general approach, there is a short-term, short, medium, and long-term kind of consideration, but the reference scenarios are usually prepared for 10 years. So that's the first difference. The second difference is in the repayment terms. So IMF financial support needs to be reimbursed in the short term, and usually repayments start after 3 years and a half. In the case of the Commission, and this, I mean, maybe it is something I need to make clear, everything we are saying about the Commission is basically based on the experience of Greece, largely based on the experience of Greece, is the repayments usually come in the long term. There is also difference in terms of interest rates. The IMF usually applies a premium, so there is a penalty rate. Usually there are 300 basis points, while in the case of the ESM, who is de facto making the financial assistance, rates are concessional. One element which is very much linked to the last slide that Daniel showed is that when it comes to this feedback loop, feedback mechanism, in practice, this is expressed in the analysis by a very small parameter. And there is a difference in the assumption that the IMF and the Commission makes about the parameter. This is basically a sort of sensitivity parameter to how much the interest rate changes when there is a change in the debt to GDP above a certain threshold. And this parameter is 0.4 for the IMF and 0.3 for the Commission, 0.03 and 0.04, sorry. So very small and very limited difference, but actually it can engender dynamics which are very, very different in the two cases. Another element for the comparison, it relates to the incentives and the governance structure of the IMF and the Commission. And as a matter of fact, the IMF is sort of technical institution which is usually very remote relative to country, for instance, of the euro area. When it comes to the Commission, of course, decisions which are taken tend to have a very strong political dimension, and the risk of spillover effect on all the countries may be much larger than in the context or in the perception of the IMF. And last but least, there is an aspect on which actually I will come more in detail later, is that basically when financial assistance is agreed to a certain country, there may be a risk of having an error. So basically one can incur in a type 1 or type 2 error where basically you have a false negative signal about the sustainability of the debt or a false positive signal about the sustainability of the debt. And one issue which is actually very important, not least from the perspective of the country which is in trouble, is what kind of error can actually materialize and what are the costs associated to these potential errors. But I will explain this more in detail in a moment. Let me now move to explain very quickly what is the general approach of the IMF and the one of the Commission. So the IMF approach is general, and it is actually, there is not a significant difference between normal times and times of crisis. So the same kind of analysis is used in both situations. It's then that there are further stages in case a country requests for support. The IMF, of course, has a very long experience in providing financial assistance, and it should be noticed actually that most of the experience is based in emerging economies and less developed economies. So when the crisis erupted in Greece and the IMF intervened, it was really a special case. It was an advanced economy. It was basically not really balance of payment of crisis, but rather financial crisis. And the context was very different. Greece part of the euro area with all the institutional, political and economic consequences. Actually, the change was so important that in 2011 the IMF undertook a modernization of the DSA framework to make it more flexible. in practice, how does it work? Basically, it's just an Excel file which is pre-constructed and where the data are inserted according to the country, and all the information is basically prepared around what is called Article 4 consultation that the IMF has with every country. So there are a number of hypotheses which are preset. In this sense, it's a very standardized template, 5 years time horizon, as explained earlier. Growth projections are taken directly from the World Economic Outlook, and then assumptions about the interest rate come from market data and from the literature, which is actually quite vast and mostly prepared by IMF staff. And then some assumption about the primary balance. And the basic assumption is actually that there is no policy change, and then the alternative scenarios are run assuming that there are differences or changes based on historical evidence or track record of a certain government to run, for instance, primary surpluses, or political feasibility given the specific context. So this basically generates a baseline scenario, alternative scenarios, and then also some stochastic simulations are prepared in order to account for the uncertainty and for feedback effect. So this is what the IMF produces. Now, in the case of the European context, before I explain what the Commission does in normal times, it should be noticed that actually the DSA is relevant into this context, two contexts which are linked to the treaties. The first one is the SGP, so the basically debt sustainability assessment is part of the surveillance exercise. And the second one is the ESM treaty, where basically the provision of financial assistance is conditional to the fact that debt in the requesting country is sustainable. So the debt sustainability analysis must be positive. And then, of course, this is also used to prepare the adjustment program. So in the framework of normal times, that sustainability assessment is prepared is part, let's say, of the debt stability monitor, which is prepared for all EU member states every year. And the assessment is, the purpose is really to assess vulnerability and risks to that sustainability. And when you go through the way this is done, there are actually quite a lot of similarities with the IMF and few differences. And as I mentioned earlier, one of the key differences is the time horizon. And the fact that the Commission considered 3 different time horizons and separate indicators associated to each of them. There is then a long list of alternative scenarios, including one which is called the SGP, where basically projections are made assuming that the country fully complies with the SGP, and then also stochastic simulations are produced. So generally speaking, in terms of outcome, most of the elements are common to the two institutions. Now, if the country is found vulnerable, what it needs to be done is an enhanced DSA. As most of you may have noticed, we just launched a question, and the question is, should the DSA become the key metric of the SGP, maybe even replacing the fiscal rules? So while the question is answered, I'm moving to the the next slide. Sorry, I jumped one. Where basically I want to spend just 2 minutes very shortly to speak about cross-financing needs. So this is not part of the DSA, but it's basically one complementary indicator. And the ESM has done quite a lot of research emphasizing the importance of this variable, which is particularly relevant basically in turbulent times because gross financing needs can be affected by market refinancing conditions, and situation of liquidity may turn into situation of unsustainability. Now, without spending too much time, on what ideas say is, I think what is interesting to say here is that there is a sort of rule which seems to be common for both the Commission and the IMF, that a gross financing need at 20% is a sort of threshold for signaling vulnerability. And just to have an idea, it's basically gross financing need is broadly calculated by debt divided the average maturity of the debt. So if the debt is at 100% and the average maturity is 5 years, we are around 20%. Now, one reason why I wanted to point to the gross financing need is that the conditions to which financial support is extended to a country can actually affect gross financing condition. And why this is not really an issue in the case of the IMF, because usually the amount of the assistance is limited, and also because the time of the assistance is also limited. In the case of the ESM, based on the experience of Greece, actually the fact that there was no limit, and in the end the amount which was lent to Greece was very large, and the fact that the maturity has been extended a lot has actually affected significantly gross financing needs. I'm now moving to the debt sustainability analysis as decision making in situation of distress. Now, as basically based on what Daniel said at the beginning and what I mentioned until now, in principle, this should be still straightforward. So especially in the case of the IMF, if debt is sustainable and the country is in distress, it should receive financial support. If the debt is not sustainable, financial support should be possible only if there is an haircut. The IMF has a similar kind of approach, though it's based more on probability, but here the very fundamental issue is that this sustainability entails a lot of uncertainty. And this is basically what we want to highlight now. And here I'm coming back to what I had mentioned before, and the issue of the possible costs which are associated to errors because of uncertainty. So in this table, what we have summarized is basically we consider a situation on the vertical, on the columns, say what was true, what can be said as true. So that was sustainable and not sustainable, and along the lines, whether this was judged sustainable or unsustainable. So the first quadrant, where it was that basically the very light blue was not sustainable and it was judged not sustainable, there is no issue. There is basically no granted support, or support is granted only with an haircut, which may be sufficiently large. And then on the opposite, on the bottom right, there is no issue because that was sustainable, it was found sustainable, so ESM granted a program which, since that was sustainable, should be successful. Now, the two tricky cases are the other two. And basically, what we have here is that in the right-hand side, the up quadrant, we have a sort of error of type 1, where basically that was unsustainable, was sustainable but was considered unsustainable. So in that case, basically default or an haircut is imposed, but actually was necessary. Now the fact is that this is, we can never observe whether this was sustainable ex ante, but as a matter of fact, this case entailed a large cost on the home country. The opposite case, where actually the debt was not sustainable, but it was assessed as sustainable, can also entail a cost, again, for the home country. But if there is actually contagion, there can be also a very large cost for the euro or the euro area member states. in the case of a European country. So this is a bit to highlight a dimension which is not often taken into consideration in the DSA, but it's part of the decision making in a situation of crisis, and different weight actually can be attributed to the two kind of errors. Now I give the floor to Daniel to mention that actually it is not only an issue of actually uncertainty and the potential cost of making a mistake, but actually real world may be even more complicated than what I mentioned until now.
Okay, thanks. Let me be brief because we're running over time. And this, what I'm saying now is a bit of background to the question which you are seeing there. Because we always have talked about the interest rate and the risk premium. And as a matter of fact, what you have to take into account is, of course, there's a difference between long and short-term rates. Government debt is usually financed by a mixture of all long and short, and usually, not always of course, usually you have a yield curve which is upward sloping on the risk-free rate, and this is important, on the risk premium you also have an upward sloping upward sloping curve. This implies that the long-term rates, the 10-year rate, which you see often in newspapers, is very often looked at, and then people say long-term rates, let's say for Italy 3%, nominal growth of nominal GDP is about the same number, depending what you assume on inflation and growth. So the country is borderline in a very difficult situation. But if you look actually at the numbers, especially for these days, you see that the short-term rate here, taking 2-year rate, is rather low. Then if you take the average between the two, which corresponds to the average maturity of Italian government debt, you see that today Italy is actually paying around 1.6%. That's the cost of new debt on average. And as I said last year, right on the slide, last year, 2017, the average cost of all Italian debt issued in that year, 2017, was on less than 1%. Between 10-year and 2 years, the average rated by issuance. So you have to look at these interest rates separately. And as I said, the risk premium that the IMF and the Commission take as an essential element in the analysis, this actually also has a upward sloping curve. So, and that's why, for example, in the IMF, you have this conclusion that you need a large fiscal surplus, the primary surplus, I should say rather, for Italy to stabilize the debt to GDP ratio. If you look at the actual marginal interest cost, then this is not so clear anymore. Because even with a zero balance on the primary deficit, and I being lower than G, but I meaning the average cost, the Italian situation is perfectly stable. Of course, the actual interest payments today reflect much more interest rates of years in the past, and therefore they are still somewhat higher. We can show you on the next slide the actual interest payments as a percent of GDP. And here you see, perhaps you see from afar the blue line, which is Greece. Of course, a big upward movement during the crisis. And then they got all the cheap financing, with the result that right now the average cost of debt for Greece, premium of debt, is much lower. And as a percent of GDP, it's about at the same level as that of Portugal. Italy actually has a rather high, that's a red line, high cost of debt. Of course, courtesy of risk premium of the past. And Portugal had at least some ESM financing, which helps to lower the average. And you see the little tick up at the end. That is because this projection was made at the peak of the last Italian crisis. If you were to put in the numbers of today, the rate would go down. But as I want to say earlier, I mean, the actual cost of serving the debt is not higher for Greece, although it has a higher debt ratio. So how do you judge Greek debt? If Greek debt is not sustainable, then maybe you should say the same about Portugal and Italy, because the actual cost of debt is very similar, and all the other parameters, namely the growth rates and so on, are also roughly similar. So that is, I think, the real-world complication that you have to take into account. And here, that brings us back to the case of Greece. Let me not go too long into that, because on that people have made up their opinion. We perhaps show you the next slide, which shows you why the IMF, or one of the reasons why the IMF and the Commission came to different, or the Europeans, right, Commission plus ESM and so on, came to different results, because you see a slightly different link between the debt level and the risk premium leads to a much quicker explosion or a much lower explosion. And actually, in some cases, it's very difficult to see. If you take the middle line, the green one in both charts, this is upward sloping in one case, IMF, and downward sloping in the other. Why? Because just a little bit higher impact of the debt level on the interest rate, on the risk premium, gives you either an explosion or the opposite. Just to show you how fine-tuned these things are, and that brings us to the last slide of last but one. I think Cinzia already showed you why is the Commission more likely to find debt to be sustainable. The first point is if you give some country a loan for 30 years, then the gross refinancing ratio is lower, right? Quite clear. And if you refinance all of the public debt, then the gross refinancing ratio could go to zero. So that's the first point. And then on the interest rate, as I said earlier, just to have this very small difference in the parameter, small in absolute terms and, if you want, large in relative terms, 0.04 and 0.03, that improves sustainability, and the knife edge can be somewhere else. What I have not put in there is that also some people say, Greece, just because, not because the debt service cost is higher, but because the debt ratio is higher, growth rates will be lower, and then of course that would even further depress sustainability. The IMF talks about that in its analysis, but doesn't really show the quantitative importance. And all of that is combined with the fact, or perhaps explained, rather, I should say, with the fact that, as Cinzia said earlier, if you make a mistake in Europe and Italy goes bust when it shouldn't have, the costs are immense. For the IMF, well, that's marginal, right? And that is why there's a difference, and that's why perhaps rationally the two institutions have a different loss function, so to speak, and therefore weigh not different probabilities, and they already weigh different probabilities differently, but also they have an incentive to come to different results. So let's not go too much into Greece. That has been discussed at depth, but I think we have seen the background, we have seen the incentives of different institutions, we have seen the technical analysis why they can have different results. Let us stop here.
Thank you, Cinzia. Yeah, let's give maybe some time to our participants to fill the form and contribute to the poll. And then what I would suggest is that if you're okay with that you start maybe the Q&A, giving some time to participants to write their questions. Start the Q&A session by interpreting a bit the results that you can see on the chat box.
So basically, the first question, which was about whether the sustainability analysis should become the key metric for SGP, we have basically 50-50, so 45-55. So it's quite it's split. So that's actually quite interesting. The second question, which is about whether DSA should be the sole criteria for policy decision making, is very clear cut. So 94% of participants say no.
So they advocate disregarding the ESM treaty. 94% of our participants from central banks.
So, assuming, starting from the point that the ESM treaty requires that there is a positive DSA outcome in order to provide financial assistance.
Good thing that these are anonymous, otherwise Mario Draghi should call some people.
But maybe it can be a result also of the point we stressed and the kind of different perspective that actually different institutions have spillovers effect and uncertainty.
But in fairness, the question was saying that can DSA be the sole criterion, right?
Yeah.
Well, that's what the ESM treaty says in principle.
Okay.
Quite clear.
Okay, so on the question 3 results, interesting. 33% for yes, no, 33 exactly the same thing. And then except 1 and except 2, and I think it's a secret polichinelle who are the first and the second countries. Very good. Okay. It's the right moment to ask to look at our participants and invite them really to contribute to their in the chat box. It was very interesting, very insightful presentation. Thank you again for this. I'm sure there will be a few questions on the various aspects, perhaps on the case studies. So let's wait a few minutes for that.
I take the occasion just to say one word about Greece to link it back what I said at the beginning. Foreign debt versus domestic debt. In the case of Greece, it was basically almost all foreign debt beforehand. So what the ESM was doing was basically collecting the debt from foreigners and refinancing it partially after a haircut, right? Was substituting itself for a foreign market. In the case of Italy, it would be different. In the case of Italy, the ESM would be bailing out Italian taxpayers, or Italian bondholders, should have said, right? And the question is, of course, that's political, but also, why should a country receive, if you want, a capital transfer from abroad when it has an internal disequilibrium? An internal distributional fight between taxpayers and bondholders. So the economics is quite different.
Okay. So there is a question by Luca. I don't know if you can read it from Brussels. Yeah. Go ahead. On the.
So basically, Luca is asking whether there is whether the incorporation of the DSA in the SGP is part of the political debate, of the policy debate. As far as we know, not explicitly, but this is something that the Commission actually may have considered. But I don't know if Daniel has any insight. But
no, really, one must admit there's not much discussion going on. Let's say effective discussion going on here in Brussels on going forward. And I think nobody now, especially also given the Italian situation, wants to touch the issue of sustainability of debt, bringing it into the Stability Pact and the other fiscal compact. So there's no political appetite for that right now.
Okay. Thanks.
There is then a question on whether contingent liabilities are taken into consideration. On this, maybe I can reply based on my reading of how the IMF and the Commission take this into consideration. So they're usually not part of the baseline scenario, but both IMF and Commission generate alternative deterministic scenarios, and usually one of that one is based taking into account contingent liabilities. I cannot add more than this, but it is certainly one of the scenarios which is built by both institutions.
Okay, thanks. There was a question by Dennis on spillovers.
Yeah, that's basically whether spillovers are taken into account when decisions are taken when coming up with that sustainability.
De facto, yes. Theoretically, no.
So theoretically, no, exactly because the ESM in principle says that the decision...
Let me rectify that. If you look at the ESM treaty, it says if it's not sustainable, then no. But of course, any request for assistance should be considered if and only if it threatens the stability of the euro area as a whole. So if Lithuania comes and says we are insolvent, but financial markets otherwise, we're insolvent, we cannot refinance ourselves, but otherwise financial markets in the rest of the euro area remain calm, then in principle the ESM should say no. The IMF would be free to do so. Okay. Let me just add, because this is a rider which is not unimportant. The purpose of the IMF is not so much to safeguard the global financial system, but to say if there's a country which has refinancing difficulties abroad, right, balance payments, then it makes sense to help it. But not because we want to save the world, because we want to be helpful to the country concerned. Whereas the ESM basically says our purpose in life is not to help countries, but to intervene only if our own well-being, meaning our own financial stability in the rest of the euro area, is affected. Otherwise, we say bye-bye.
There is then a question which is asking about the different 0.03 and 0.04 used by the European Commission and the IMF respectively. So the number used by the IMF basically comes from empirical estimates and the literature. So it is what we also realize, it is largely based on large literature on emerging market economies.
Yes, otherwise you don't find it.
That's basically because it's where the cases are. If you want to look at how the debt evolves above a certain level and when there is issue of sustainability. In the case of the Commission, actually, there is a footnote explaining that this is the parameter in the debt sustainability assessment of Greece. We do not know more than this. That's basically...
basically, the standard error bounds around these things are very large and certainly encompass 0.4 and 0.03. And of course, as somebody remarked, if you run the regression during 2011-12, you get one result. If you run it in 2007, you get another result. And if you run it again today, so it is very much dependent on the state of financial markets.
Then there is a question for clarification of when the country is found vulnerable. This is still in the framework of the SGP. So, I mean, for the ESM to intervene, it's necessary that there is a request coming from the country. Yeah? So, what I've explained just refers to the SGP. So, it's still in normal times. But it's just elements signaling that there is high risk. Then there is this question about whether gross financing needs will be used instead of debt sustainability.
This is not our methodology.
Yeah, this is not our methodology.
This is basically, it favors for the ESM, it's actually very handy. Because that way they can make any country sustainable. If it's a gross financing needs, and as I said earlier, you give them alone. It's long enough. That's why the IMF doesn't like it, because it wants to get out and wants to see the country stand on its own feet. And it's just an elastic band which the ESM can use to make any country sustainable.
Then there is a question on how to incorporate the willingness to pay or the political risks.
That's an easy one.
That's a good one.
That is, no official institution can do that. The rating agencies do that implicitly, because if you look at the ratings as a function of debt and growth and so on, and then you put in the usual corruption indicators from the World Bank or others, you find that they're highly significant. So quality of governance, corruption indicators, they all lead, or bad indicators on these accounts all lead to lower ratings and also to higher risk premia. But unfortunately, this is not something which an official institution can use.
The only thing I can add very briefly is that, for instance, in the case of Italy, the IMF says that for debt to stabilize, a large primary surplus is required, but based on historical track record, this is unrealistic. This is unrealistic. So to some extent, this is not explicitly included, but parameters can be adjusted a lot based on the expected political cycle in the future and on the past track record in terms of ability to run surplus for a long time. So that's the way basically the IMF and the Commission.
Okay, thanks. There was a question by Francesco. Buongiorno, Francesco, by the way. About Italy's risk premium incorporating renomination risk. Maybe Daniel or...
Yeah, I mean, that is, of course, something which is very relevant for the euro area. I take the second part of your question first. Countries, of course, prefer to repay in their own currency, and that's why also you have many de facto defaults through inflation. But the idea that you can somehow escape a risk premium is just not true. You just think about Italy in 1995, when Italy had its own currency. So in principle, the risk premium should have been zero, at least the nominal risk premium. But then what you get is a real risk premium, which is equivalent. So yes, countries prefer to repay debt in their own currency. And if you're talking about countries outside the EU, that happens. So you have still zero nominal default risk at home. But if you have open capital markets, then you have still an exchange rate risk or inflation risk which is incorporated. And the result is that you get more or less the same relationship between the real cost of public debt and the debt ratio.
Then there is a question on whether in a certain situation market expectations or risk appetite actually can drive sustainability instead of the fundamentals. So that's basically the situation where liquidity problems can turn into sustainability problems. So this is very tricky. And actually the interest that there is now on gross financing needs to focus on this is basically to capture this situation where in the short term changes in the cost of refinancing that can actually have an impact on long-term sustainability. Otherwise, standard that sustainability assessment, given that the time span and the time horizon is very long, is very difficult to be accounted for. Then there is the question on assumptions. Which may be too rigid, too flexible.
I think it's always good to have more than one, so that I think some people might think it confused, but I think it clarifies that this DSA is not a scientific objective exercise, but one which incorporates a lot of subjective assumptions and mechanisms which do not work always with the same precision, and therefore yes, it's better to have two than one.
Okay.
Yeah, and then I think that there is just a comment which is basically
I saw that.
yeah, mentioning.
Thanks a lot. I know that, you're quite right. Now we have to, maybe you're a lawyer, I don't know. We have to interpret it and of its member states plural, not of the member state requesting requesting help, right? So one would have now to go into the background on the discussions of the ESM, but I still stay to my statement that the ESM, I think, is unlikely to intervene in the case of a country which does not pose a systemic threat to the euro area, and a country which doesn't have a lot of political friends. Let's be.
And then there is a last question, this I leave it to Daniel. So what is the right evaluation for Greece? That's the way I would read it. So, no, it's actually about whether the assumption for Greece were not realistic in 2011 and how they are different today.
Now, the assumptions were certainly not realistic in 2011, that's quite clear. But then realistic. Okay, a little bit of hindsight also we have today. But I must admit that, let's say, those observers who were not beholden to official lines were much more pessimistic. So in that sense, yes, they were even, I think, objectively too optimistic. But in the end, the judgment was, do you want to carry the political, if now I'm talking about the European instances, do you want to carry the risk of further disturbances if there's a second haircut, right? Once you had done the first haircut and turned out it wasn't sufficient. Or do you say, we'll put that stuff on our balance sheet, anyway the carrying cost is close to zero, and if we do that and for a long time, then we have a chance that the Greeks actually pull it through. I think that was the implicit judgment made after it became clear that the first haircut wasn't enough. That's something which I could underwrite, but not with a big degree of confidence.
I mean, maybe just one word on this, and then we close, is that in the case of Greece, and actually we have discussed this several times, now when there is the provision of financial assistance, there is also a program which is attached to it. So the way actually that the program, the adjustment program plays out and the performance of the economy is affected can influence the ability of repayment and to some extent to verify in a positive way the assumptions that were made, or basically to say that they were completely wrong. And I think what we can say that the first program of Greece, it was certainly not successful because of the assumptions which were made also in the adjustment program and the way the economy was expected to react to the program. Actually, the expectations were not met.
Well, let's come back to the point which was raised earlier about governance and credibility in the end. The economic fundamentals of Greece and Portugal were very similar. The programs in both cases were not realistic, if you want. In Portugal, it worked out in the end. Why? Because the Portuguese economy responded differently, and presumably responded differently because the Portuguese government actually implemented some reforms. Now the Greeks signed up to basically the same thing and more, right? Hundreds of pages of prior actions and all that stuff. This is the problem. You are an official institution. You come to the country and say, this is what you need to do to be sustainable. They say, show me where I can sign. They sign. Can you tell them, look guys, I don't believe your signature? And that is what they should have said in the case of Greece. Mm-hmm. But political reality is that in Europe you just cannot do that.
As Fotaini is saying, so the problem was political. I think we have to, we're over time, so it would be good if we close the seminar. Maybe we just address this last and maybe difficult question on of Riccardo on Italy's debt. So what's in your view the right evaluation for Italy's debt, and then we close.
In my view, it is sustainable because it's mostly held by Italians, and the political system seems to be such that there's no willingness to actually deal with it in the sense of getting the ratio down, but enough willingness to pull back from the brink each time things threaten to go out of hand. So I think it will be on the borderline for a long time, but in the end it will, with a high degree of probability, turn out to have been sustainable.
Okay. So this seminar is almost over. Thank you to our speakers, Daniel, Cinzia, for your time and dedication, and to all of you for your questions and comments. If you'd like to go on discussing reading on this topic, so we have compiled a short reading list which include Daniel's and Cinzia's paper, as well as a few contributions from Aitor Erce and Giancarlo Corsetti, who have been part of our annual conferences in past years. We'll have a next seminar on the 8th of February on liquidity and resolution, so stay tuned. And last but not least, you may have wondered with the introductory polls who was the most effective banker among the Medici. He was Giovanni, founder of Banco Medici. Basically, Lorenzo, the most famous of the Medici, was just spending the money and being a nice and useful art sponsor. So thank you again for watching, and have a good rest of the day. Bye.
Thank you very much.
Thanks a lot.